Hi friends, welcome to new video. The Federal Reserve raised interest rates for the ninth consecutive time on Wednesday, choosing to continue its campaign against high inflation despite tensions in the banking industry after the collapse of two regional banks. Fed policymakers voted unanimously to raise their benchmark interest rate by 1/4 percentage point to just below 5%, making it more expensive for people with car loans or carrying balances on their credit cards. Will be done. Members of the Fed's rate-setting committee believe slightly higher rates may be necessary to restore price stability. On average, policymakers expect rates to rise another 1/4 percentage point by the end of this year, according to new estimates also released Wednesday. The committee believes that some additional policymaking may be appropriate, the Fed said in a statement. Some observers have urged the central bank to put its rate hikes on hold, at least temporarily, to assess the damage caused by the collapse of Silicon Valley Bank and Signature Bank earlier this month. My name is Matthew and you are watching 72 Info TV, so subscribe to our channel before we discuss this news. However, the stress in the banking system appeared to be easing in recent days. Treasury Secretary Janet Yellen said Tuesday that large withdrawals from regional banks had stabilized. The U.S. banking system remains strong and resilient, the Fed's monetary policy statement said. Meanwhile, consumer prices are rising at a rapid pace. Annual inflation was 6% in February, down from 9.1% last June, but still well above the Fed's 2% target. The central bank is particularly concerned about rising prices for services, such as airline tickets and streaming TV subscriptions. Fed Chairman Jerome Powell told reporters during his briefing, "My colleagues and I are well aware that high inflation erodes purchasing power, particularly for people who cannot afford food, shelter, or anything else, and are unable to cover the high costs of essential items such as transportation." Conference after the meeting. The Fed also faces scrutiny for its oversight of two failed banks. Fed supervisors reportedly identified problems with the Silicon Valley Bank's risk management practices years ago, but the problems were not corrected and the California lender faced a U.S. government takeover after the massive bank run fell. "We need to be humble and take a careful and thorough review of how we supervised and regulated this firm," said Fed Vice Chairman for Supervision Michael Barr. Barr is looking into it and has promised to report by May 1. He will also testify before two congressional committees next week. Others have called for an independent investigation into the Fed's role in bank failures. "It is 100% certain that there will be an independent investigation," Powell told reporters Wednesday. "When a bank fails, there are investigations, and of course we welcome that." Senators Elizabeth Warren, Democrat Massachusetts, and Republican Florida has also proposed replacing the Fed's internal inspector general with an external inspector appointed by the president. The Fed will need to assess the impact of the collapse of the two regional lenders in deciding how much to raise interest rates going forward. After the collapse of Silicon Valley Bank and Signature Bank, other banks are expected to be more conservative about lending. Recent developments are likely to result in tighter credit conditions for households and businesses and weigh on economic activity, jobs and inflation, the Fed said in a statement. The extent of these effects is uncertain. Tighter credit conditions, such as rising interest rates, lead to slower economic growth. "Credit is the grease that keeps the wheels of small businesses moving and the overall economy moving," said Kathy Bostjank, Nationwide's chief economist. "If that credit starts to shrink," he said, "you're going to have a huge, I would expect, pullback. This could help the Fed curb inflation. But it also raises the risk of tipping the economy into recession." Still, Fed policymakers aren't anticipating a recession. On average, rate-setting committee members expect the economy to grow 0.4% this year, according to their estimates on Wednesday. They expect the unemployment rate to rise to 4.5% from 3.6% in February. Thanks for watching our videos.